In March 2008, gold hit $1,000 per ounce for the first time, and just 6 months later, the entire global financial system nearly collapsed. Today, gold is pushing past $2,300 per ounce, and the same tremors that shook Wall Street in 2008 are being felt again beneath the surface. Welcome to the Market Antiquarian, where history and finance reveal how the world really works. Subscribe to stay informed. To understand what gold is signaling right now, we need to travel back to a moment when gold was not just money. It was the foundation of everything. In 1944, inside a grand hotel in Bretton Woods, New Hampshire, delegates from 44 nations gathered around long wooden tables covered in maps and documents. They were rebuilding the world economy after a war that had destroyed cities, bankrupted governments, and left millions of people with nothing but rubble. The agreement they reached tied every major currency in the world to the United States dollar. And the dollar itself was fixed firmly to gold. At that moment, gold became the invisible backbone of global trade, set at exactly $35 per ounce by international agreement signed in New Hampshire. For nearly 3 decades, the system held steady. Governments trusted it. Banks relied on it. The world woke up each morning inside a system built on gold. But by the late 1960s, the United States was spending heavily on the Vietnam War and on major domestic programs at the exact same time. Foreign governments noticed that the United States was printing more dollars than it held in gold reserves deep inside Fort Knox in Kentucky. France grew suspicious. President Charles de Gaulle stood before cameras in Paris and questioned whether the dollar deserved its privileged position in global finance. France then did something remarkable. It sent ships across the Atlantic Ocean to New York Harbor, demanding physical gold bars in exchange for its dollars. Other nations followed. Gold was quietly draining out of Fort Knox as country after country exchanged paper dollars for real metal stored in underground vaults. By 1971, United States gold reserves had fallen from around 20,000 tons after World War II to just above 8,000 tons, and the pressure was unbearable. On August 15, 1971, President Richard Nixon sat before television cameras inside the Oval Office and made an announcement that would change money forever. Nixon told the watching world that the United States would no longer exchange dollars for gold. In one speech, he ended 27 years of Bretton Woods. Gold bars that once backed every dollar in circulation were suddenly just metal. The dollar became a floating currency backed by nothing except human trust. The moment Nixon closed the gold window, something ancient shifted in the global economy. Money was now a pure human invention, free from natural limits. Within 2 years of that 1971 decision, gold prices began rising sharply as investors worldwide tried to understand what their dollars were actually worth without gold. By 1974, President Gerald Ford signed a law restoring the right of Americans to own gold, a right that had been restricted since President Roosevelt acted in 1933. Long lines formed outside gold dealers in Chicago and New York as Americans purchased gold coins and small bars for the first time in over 4 decades. But the real explosion came later. Through the late 1970s, inflation in the United States rose to levels that genuinely shocked economists and financial planners nationwide. By 1980, inflation had reached nearly 15% annually, meaning groceries costing $100 in 1970 cost nearly $250 just 10 years later. Gold responded to this crisis with a historic surge. In January 1980, gold prices reached $850 per ounce, a level that stunned markets everywhere. When adjusted for changes in purchasing power over time, that 1980 peak of $850 equals roughly $3,000 today, a figure economists still examine carefully. Then came Paul Volcker. The Federal Reserve Chairman walked into the central bank in Washington, D.C., and made a decision that caused immediate and widespread economic pain. Volcker raised interest rates to nearly 20%. Mortgages became nearly impossible. Car lots across America sat empty until factories closed. Unemployment climbed past 10%. But the medicine worked. Inflation fell. The gold strengthened. Gold prices collapsed from their 1980 peak, falling back toward $300 through the 1980s and 1990s. For nearly 2 decades, gold was forgotten by most investors. Stock markets were roaring. Technology firms were creating fortunes, and gold seemed like a relic of fear. Then came the year 2000. The dot-com bubble burst, and the Nasdaq index in New York fell by nearly 78% across the next 2 very painful years. Investors who had abandoned gold suddenly remembered why it existed. Gold began climbing quietly from around $250 per ounce in 2001, drawing in cautious and careful money. Then came September 2001. Smoke rose over New York City. The Pentagon was struck. The United States economy absorbed a shock unlike anything seen in recent decades. The Federal Reserve responded by cutting interest rates aggressively, making it cheaper to borrow money and encouraging spending to prevent a deeper economic collapse nationwide. Low interest rates made gold more appealing because gold pays no interest at all. When savings accounts offer almost nothing in return, the ancient metal attracts attention. Gold climbed steadily through 2002, 2003, 2004, and 2005, rising year after year as low rates, military spending, and growing government deficits made careful investors uneasy. By 2006, something troubling was growing inside the American housing market. Home prices in Miami, Las Vegas, and Phoenix had risen far beyond what ordinary families could afford. Banks across the United States issued mortgages to millions of borrowers with little income, little savings, and little ability to repay if economic conditions shifted at all. These risky mortgages were bundled into complex financial products and sold to investors worldwide, spreading hidden risk into every corner of the global financial system. Rating agencies in glass towers on Wall Street in New York stamped these bundles of risky debt with their highest safety ratings, giving investors completely false confidence. By early 2007, cracks were visible. Mortgage defaults were climbing. Small lenders were quietly failing. Foreclosure signs appeared in suburban neighborhoods across the entire country. Gold watched all of this and responded. Through 2007, gold climbed past $700, then $800, then crossed $900 as anxiety spread through financial markets. In March 2008, Bear Stearns, one of the oldest investment banks on Wall Street in New York, collapsed so fast that regulators arranged an emergency rescue over one weekend. The moment Bear Stearns fell, gold broke through $1,000 per ounce for the first time, as investors worldwide scrambled toward anything that felt real and tangibly safe. That $1,000 milestone was not just a number, it was a signal. It was the market announcing that something large and dangerous was hiding inside the financial system. 6 months after gold crossed $1,000, Lehman Brothers filed for bankruptcy on September 15, 2008, the largest bankruptcy filing in United States history at that time. On that September morning in 2008, the Dow Jones average fell over 500 points. Credit markets froze worldwide. Banks stopped trusting each other almost completely overnight. In cities from London to Tokyo to Sydney, financial officials gathered in emergency meetings, staring at screens showing numbers that none of their models had ever predicted. The United States government launched a rescue program worth $700 billion, called the Troubled Asset Relief Program, to prevent the complete collapse of American banking. The Federal Reserve then began purchasing government bonds by creating new dollars at a scale never attempted before in the entire history of the American financial system. Between 2008 and 2014, the Federal Reserve expanded its balance sheet from roughly $900 billion to over $4.5 trillion, flooding the system with newly created money. Gold surged. After a brief drop during the 2008 panic, prices climbed dramatically from around $700 to over $1,900 per ounce by September 2011. That 2011 peak happened because investors around the world looked at the scale of money creation by central banks and asked a question that gold always forces people to ask. The question was simple. If governments can create money without limit, what does that money actually represent, and what is it truly worth over the long term? That question is not new. It was asked in 1971 when Nixon acted. It was asked in 1980 when inflation hit. It is being asked again today with greater urgency. After 2011, gold fell back as the Federal Reserve signaled it would raise interest rates and reduce money creation, cooling the fear that had pushed gold prices higher. For several years, gold drifted between $1,100 and $1,300 per ounce as markets calmed and stock markets in New York resumed their long, steady climb upward. Then came 2018 and 2019, and something shifted again beneath the surface. Trade tensions between the United States and China began disrupting global supply chains built over decades. Factories in China supplying American retailers faced new tariffs. Shipping containers in ports from Shanghai to Los Angeles carried goods that were suddenly more costly to move. Central banks worldwide, including those of Russia, China, Turkey, and Poland began buying gold at rates not seen since the years immediately following the 2008 financial crisis. In 2019, central banks globally purchased over 650 tons of gold, the highest level of central bank gold buying recorded in more than 5 decades of reliable market data. These were not small investors chasing a trend. These were governments making long-term strategic decisions about how to protect national wealth in an increasingly uncertain world. Russia had been selling United States Treasury bonds and replacing them with gold bars inside Moscow vaults, a shift that financial analysts in Washington, D.C. studied carefully. China was also accumulating gold, though its officials reported holdings gradually, making the full scale of the Chinese gold buying strategy difficult to track with any precision. Then 2020 arrived, and the world stopped. A health crisis spread from city to city across every continent, forcing governments to halt economies that had never been stopped before. Governments responded by spending on a scale that made even the 2008 rescue programs look modest. The United States alone approved trillions in emergency relief within just weeks. The Federal Reserve cut rates back to near zero and restarted bond purchasing. Expanding its balance sheet past $7 trillion within months of the global health crisis beginning, gold crossed $2,000 per ounce for the first time in history in August 2020 as investors absorbed the enormous scale of worldwide money creation happening simultaneously. That $2,000 moment felt significant. It carried the same weight as $1,000 had in March 2008, a threshold demanding attention from anyone paying close enough attention. But unlike 2008, the story did not end at that peak. The 2020 surge was followed by consolidation as markets debated whether the emergency conditions would become a permanent reality. Then came inflation. Beginning in 2021, prices across the United States and Europe rose at rates not seen since the early 1980s, driven by supply disruptions and new money. By mid-2022, inflation in the United States had reached over 9% annually, the highest level recorded in 40 years, bringing back memories of the painful 1970s era. The Federal Reserve responded by raising interest rates rapidly, moving from near zero to above 5% within 18 months, the fastest rate increase cycle recorded in modern history. Unlike in 1980, gold did not collapse. Despite rising rates that historically pushed gold prices lower, gold held firmly above $1,800 per ounce and then climbed again. That resilience puzzled economists who expected gold to fall as rates rose. The fact that it held firm was itself a signal worth understanding and examining with real care. In March 2023, 3 mid-size American banks failed within days of each other. Silicon Valley Bank in California collapsed on a Friday after a social media-driven bank run. Signature Bank in New York followed within days. First Republic Bank in San Francisco later failed, requiring a rescue arranged by larger banks working alongside federal financial regulators. Each bank failure sent fresh anxiety through financial markets, and each wave pushed cautious money back toward gold, which climbed as depositors sought something tangible and reliably real. By early 2024, gold broke above $2,100 per ounce, setting new records as the United States national debt crossed $34 trillion, an amount almost impossible to visualize clearly. To visualize $34 trillion, stacking $1 bills flat, would build a pile reaching from Earth to the sun and back more than 23 times without stopping. Central banks kept buying gold through all of this. In 2023, global central bank gold purchases stayed above 1,000 tons for the second year running, a completely unprecedented pattern. These governments were not making short-term trades. They were restructuring their national reserves, quietly reducing dependence on the United States dollar as their primary financial foundation. The share of global central bank reserves held in United States dollars fell from around 71% in 2002, approximately 58% by 2023, a slow but meaningful and historic shift. When reserve managers in Beijing or Moscow replaced dollars with gold bars, they are expressing a considered view about the long-term stability of the entire dollar-based financial system. Gold prices above $2,300 in 2024 reflected a genuine reshaping of how nations choose to store and protect the wealth built over generations of work and sacrifice. The signal gold sends today carries echoes of 2008, but also echoes of 1971, of 1980, and every moment when governments created money faster than their economies could absorb it. Each of those moments had a different trigger, different decision-makers, and different immediate causes, but they all shared one connecting feature that links them clearly across decades. In every case, gold began rising before the crisis became visible to ordinary observers. It moved first, quietly, while confidence was still high and official statements remained calm. Those who understood what gold signaled in early 2008 were not fortune-tellers. They were historians who recognized a familiar pattern unfolding in real time against borrowed confidence. The question today is not whether history is repeating exactly. History never repeats exactly. The question is whether the pattern is close enough to deserve serious and clear attention. In 2008, a single number kept appearing in financial circles before the crash. That number was rising gold prices, and almost nobody in power wanted to talk about it. Today, that same number is rising again, faster and higher than before. And the question every serious observer is now asking is what exactly gold already knows that we do not. There is a concept in financial history called a leading indicator, meaning a signal that moves before the larger event it is predicting becomes visible to the general public. Housing prices were a leading indicator in 2006, bank lending rates were a leading indicator in 2007, and gold was a leading indicator in early 2008 before Bear Stearns fell. What makes gold uniquely powerful as a signal is that it cannot be printed by any government, cannot be created by any central bank, and cannot be multiplied by any computer algorithm. When paper money loses credibility in the eyes of investors, gold bars sitting in vaults in London, Zurich, and New York become the measuring stick against which everything else is judged. In 2008, the Federal Reserve in Washington, D.C. held approximately $900 billion in assets on its balance sheet, a figure that seemed enormous at the time to most economists. Today, that same Federal Reserve balance sheet holds over $7 trillion in assets, a number nearly 8 times larger than the pre-crisis level that once seemed so extraordinary. That expansion of the Federal Reserve balance sheet represents one of the most significant changes in the history of American money, and gold prices have tracked every step of that expansion. Think of it this way. Imagine a bakery that has always made 100 loaves of bread per day. Now imagine that bakery suddenly starts making 800 loaves, but the number of customers stays the same. Each loaf becomes worth less because there are more of them competing for the same number of hungry customers. That is exactly what happens when central banks create money at scale. The loaves in this story are dollars. The hungry customers are the goods and services in the economy. And gold is the oven that cannot be made any larger, no matter who tries. This is why throughout history, from ancient Rome to medieval China to modern America, gold has always risen when governments expanded money supply beyond what economies could absorb. In ancient Rome, emperors reduced the silver content of their coins to fund military campaigns, and prices across the Roman Empire rose sharply in response to the diluted currency supply. In 1920s Germany, the Weimar Republic printed enormous quantities of paper marks to pay war reparations, and citizens in Berlin soon needed wheelbarrows of currency just to buy a single loaf of bread. These are not distant, abstract historical curiosities. They are case studies in what happens when the supply of money grows faster than the supply of real goods and real services in an economy. Today, the United States national debt stands at over $34 trillion, growing by roughly $1 trillion every 100 days, a pace that has no historical precedent in peacetime American history. Every time the United States government borrows another $1 trillion, it issues Treasury bonds that the Federal Reserve often purchases, effectively creating new money to fund spending. Gold watches this process with the same patient indifference it has shown for thousands of years. It does not panic. It does not celebrate. It simply rises when the math no longer adds up. The math today is showing something similar to what it showed in 2006 and 2007, before most people realized that the American housing market had been built on a foundation of borrowed confidence. In 2006, the total value of subprime mortgage bonds held by banks and investment firms across Wall Street exceeded $1.3 trillion, most of it rated as safe by the very agencies paid to rate it. Today, the total value of United States government bonds held by foreign central banks, pension funds, and insurers around the world exceeds $33 trillion, all denominated in dollars. If confidence in those dollars erodes even slightly, the consequences would ripple through every financial market on every continent simultaneously. in a way that 2008 only partially previewed. This is not speculation. This is the same concern that led the central banks of Russia and China to begin reducing their United States Treasury holdings and replacing them with physical gold bars between 2014 and 2023. Russia reduced its United States Treasury holdings from roughly $100 billion to nearly zero, while increasing its gold reserves held inside. Moscow vaults. China has been more gradual, but equally deliberate. Chinese gold reserves grew steadily from around 1054 tons in 2015 to over 2,200 tons by 2024, reported to international bodies. These are not investment decisions made by nervous individuals watching television. These are strategic national decisions made by governments managing the financial security of entire populations. When large governments move away from paper assets and toward physical gold bars, gold prices respond because supply is fixed while demand grows permanently and measurably. There are only a limited number of gold mines operating on Earth. Total annual global gold production sits at roughly 3,500 tons per year, a figure that has barely changed in over a decade. No technology has yet been developed that can meaningfully increase the total amount of gold available on Earth, which means every additional ton of demand must compete for the same limited supply. In 2023, central banks alone purchased over 1,000 tons of gold, meaning that central bank buying alone consumed nearly 30% of the entire global annual gold production in a single year. Add demand from individual investors, jewelry markets in India and China, and technology manufacturers using gold in electronics, and the pressure on supply becomes very clear and real. India alone imports between 700 and 900 tons of gold annually, driven by deep cultural traditions around gold jewelry at weddings and festivals that have persisted for thousands of years. In the streets of Mumbai and the markets of Delhi, gold bangles and necklaces are not just decoration, they are generational stores of value, passed from grandmothers to granddaughters. China has seen a similar surge in gold demand from its growing middle class, with Chinese consumers purchasing record levels of gold coins, gold bars, and gold jewelry through 2023 and into 2024. This combination of government buying, individual buying, and industrial demand pressing against a fixed and slowly growing supply is the structural foundation beneath the rising gold price. But there is something else happening in 2024 that was not present in the same way during the 2008 period, something that makes the current gold signal potentially even more significant to understand. In 2024, multiple central banks began publicly discussing settling trade in currencies other than the United States dollar for the first time in decades. A remarkable and historic development. Brazil, Russia, India, China, and South Africa, collectively known as BRICS, expanded their membership in 2024, adding nations representing a large share of global oil production and trade. Saudi Arabia, which sold oil exclusively in United States dollars since the famous 1974 agreement between King Faisal and Secretary Kissinger, began openly discussing alternative payment arrangements. The petrodollar system, meaning the global arrangement where oil is priced and traded in United States dollars, has been one of the core pillars supporting dollar demand since the early 1970s. If oil-producing nations begin accepting payment in currencies other than the dollar, demand for dollars in global trade would fall and the purchasing power of those dollars would weaken. Gold knows this. The gold market is driven by the largest pool of capital on Earth, including sovereign wealth funds and central bank reserve managers watching the same historical data. These institutions employ economists and historians who study the same patterns discussed here. When they buy gold bars in London and Zurich, they are acting on data and documented history. The data includes the United States federal deficit, which has exceeded $1 trillion in every single fiscal year since 2020, even during years when the economy was technically growing. In the past, trillion-dollar deficits were emergency measures used only during deep recessions or major wars. Today, they have become the normal operating condition of the federal government. The Congressional Budget Office, which is the nonpartisan analytical arm of the United States Congress, projected in 2024 that the national debt could reach $50 trillion by the early 2030s. Interest payments on the existing national debt crossed $1 trillion annually in 2023, meaning the government now spends more servicing debt than it spends on national defense. When a household spends more on credit card interest than on food and shelter, financial advisors describe that position as dangerous and unsustainable, requiring immediate and serious attention. The same logic applies to national governments, and gold has always been the asset that rises when national finances begin showing the kind of structural strain that is difficult to reverse quickly. This is precisely what happened between 2001 and 2008. The United States ran large deficits, kept rates low, allowed housing speculation to build unchecked, and gold rose every single year. When the crisis arrived in September 2008, it did not come because something new happened. It came because the accumulated weight of years of imbalance finally became too heavy to carry. The parallels to today are not identical, because history never repeats identically. But they are clear enough that serious financial historians are paying very close attention right now. One of the most telling parallels involves commercial banks. In 2006 and 2007, banks across Wall Street were quietly tightening their lending standards before the public crisis began. Small businesses applying for loans in 2007 found it increasingly difficult to get approvals from banks that had been approving similar applications, without hesitation, just 2 years earlier. Today, Federal Reserve surveys of senior bank lending officers show that lending standards across the United States have been tightening steadily since 2022, a pattern that precedes slowdowns. When banks tighten lending, businesses find it harder to grow, consumers find it harder to borrow, and economic activity gradually slows in ways that are invisible to most people at first. The sequence of events in 2007 and 2008 followed a recognizable pattern. Lending tightened first, data weakened second, earnings disappointed third, and then markets fell sharply and fast. Looking at the United States economy in 2024, lending standards are tight. Consumer credit card debt has reached record levels, and delinquency rates on loans are climbing measurably upward. United States consumer credit card debt crossed $1.1 trillion for the first time in late 2023, with delinquency rates rising to levels not seen since the years following the 2008 crisis. Meanwhile, commercial real estate markets in cities like San Francisco, Chicago, and New York are experiencing vacancy rates and price declines that recall the real estate distress of the 2008 period. Office buildings in San Francisco that sold for hundreds of millions before 2020 are selling in 2023 and 2024 for a fraction of their previous values. As remote work permanently reduced demand, banks holding loans against these office buildings are sitting on losses not yet fully recognized on financial statements, a situation that recalls the mortgage securities problem of 2007. Regional banks across the United States hold a large share of commercial real estate loans compared to national banks, making them vulnerable if commercial property values keep declining. It was regional and mid-sized banks that collapsed in March 2023, including Silicon Valley Bank and Signature Bank in New York, and the underlying conditions causing those failures have not resolved. Gold watched the bank failures of March 2023 and moved higher. It watched commercial real estate distress through 2023 and moved higher. It watched the rising national debt and climbed still. Each move higher in the gold price is the market collectively expressing a view about the gap between the official narrative of stability and the reality visible in balance sheets and data. The official narrative in 2006 and 2007 was that the housing market might see a modest correction, but that the broader financial system was sound and well capitalized for any challenge. Federal Reserve Chairman Ben Bernanke testified before Congress in early 2007 that subprime mortgage problems appeared contained and were unlikely to spread significantly to the broader economy. 8 months after that congressional testimony, Bear Stearns collapsed. 13 months after it, Lehman Brothers filed for the largest bankruptcy in American history inside one chaotic weekend. The gap between official reassurance and market reality is one of the oldest and most consistent patterns in financial history, and gold has always been the asset that closes that gap over time. In 2024, official statements from the Federal Reserve and the United States Treasury describe the economy as resilient, with strong employment and inflation moving gradually toward target levels. At the same time, gold is trading at all-time record levels above $2,300 per ounce, a direct and measurable contradiction of the reassuring official narrative currently being presented. Both things can be true simultaneously. The economy can appear strong on the surface while structural pressures build quietly beneath it, exactly as they did between 2005 and the autumn of 2008. The lesson of 2008 is not that crashes are inevitable after gold rises. The lesson is that gold rises when serious people with serious money begin losing confidence in the financial system. Right now, in 2024 and into 2025, some of the most serious institutions on Earth, including sovereign wealth funds and foreign central banks, are buying gold at historically significant rates. The World Gold Council reported that demand for gold bars and coins from individual investors reached levels in 2023 and 2024, not seen since the peak buying period following the 2008 crisis. Gold exchange-traded funds traded on stock exchanges in New York and London saw renewed inflows from institutional investors through late 2023 and into 2024, reflecting growing systemic concern. These are not small retail investors making emotional decisions. These are pension funds in Europe and insurance companies in Asia, making deliberate allocations to gold against systemic uncertainty. The word hedge in financial history means protection. When large, careful institutions buy gold as a hedge, they are stating publicly that the current system carries risks worth protecting against. That statement, made through billions of dollars flowing into physical gold bars and gold-backed financial products, is the most credible form of market communication that exists anywhere on Earth. Words can be reassuring, speeches can be calming, government statements can project confidence, but capital flowing into gold vaults in London and Zurich tells a different and more honest story. The story that capital is telling right now in 2024 and 2025 is the same story it told in 2007, before most people recognized what was coming, and in 1979, before inflation reached its peak. It is a story about the limits of paper promises, the tension between what governments say and what mathematics quietly reveals, and the ancient role of gold as the final and enduring judge. You do not need to be a financial expert to understand this story. You only need to be willing to look at the same data the largest institutions in the world are looking at without flinching. The data shows a national debt growing faster than the economy generating the income needed to service it, and a Federal Reserve balance sheet 8 times larger than before the last major crisis. It shows central banks of major nations quietly shifting reserves away from paper assets and toward gold bars, a shift building steadily for over a decade without any meaningful sign of reversing. And it shows gold itself, that ancient metal outlasting every paper currency ever created throughout recorded human civilization, rising steadily toward levels that demand serious explanation. Whether the signal gold sends today leads to a 2008-style event, something different, or a long period of gradual adjustment, only time and history will fully reveal and record with clarity. The past still has stories to tell. Subscribe and let us uncover them together.